Welcome to Academic Gain Tutorials. In this video, we will look into the differences between balance sheet and income statement. The balance sheet and the income statement are monetary reports organizations create toward the end of a bookkeeping period. The balance sheet is a preview of what the organization both possesses and owes at a particular period of time. It's utilized close by other significant monetary archives, for example, the income statement or the cash flow statement for monetary examination. The balance sheet is a fiscal summary involving resources, liabilities, and value toward the conclusion of a bookkeeping period. On the other hand, the income statement, also referred to as the profit and loss statement, shows an organization's monetary well-being throughout a predetermined time frame. It additionally gives an organization important data about income, expenses, and sales. So, let's look into the basic differences between balance sheet and income statement in a tabular form. Difference number 1. The balance sheet indicates what an organization owns, assets, and owes, liabilities, at a specific period, whereas the income statement reports total expenses and revenue over a period. Number 2. The balance sheet does not show performance, whereas the income statement records the performance of the business. Number 3. The balance sheet reports liabilities, equity, and assets, whereas the income statement records expenses and revenue. Number 4. The balance sheet is used to determine if the organization has enough resources to meet financial obligations, whereas the income statement is used to assess business performance and support financial issues. Number 5. Banks use the balance sheet to check if they should extend more credit, whereas lenders use the income statement to see if the business can pay off liabilities and make a sustainable profit. Number 6. The balance sheet is a snapshot at a particular time, whereas the income statement covers a specific period. Number 7. The balance sheet includes assets, liabilities, and equity, whereas the income statement includes income, expenses, and net profit or loss. Number 8. The balance sheet focuses on financial position, whereas the income statement focuses on financial performance. Number 9. The balance sheet shows what an organization owns and owes, whereas the income statement shows profitability. Number 10. Investors use the balance sheet to check how assets are financed, whereas they use the income statement to evaluate management performance. Number 11. The balance sheet is based on the accounting equation, assets equals liabilities plus equity, whereas the income statement has no specific equation. Number 12. The balance sheet orders assets by liquidity, whereas the income statement has no specific order for items. And finally, difference number 13. The balance sheet shows cash, stock, and property, whereas the income statement shows sales, cost of goods sold, and operating expenses. So, these are the differences between balance sheet and income statement. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.